Ambani and Mukesh Ambani, all those counters, be it Reliance Petroleum, Reliance Energy, all those counters, Reliance Industries, they are trading at all-time highs for themselves. Technology, of course, continues to be the laggard because look at the way the rupee has opened and trading in today's trading session vis-a-vis the dollar. It's sub 40 levels, 39.83, and the entire technology pack continues to look under pressure, but it's great going this morning. It's back to Ross now.
Aisha, thanks very much indeed. For that, we have some mild losses for European equity markets about an hour and 80 minutes into the trading day. On the downside, banks. On the upside, basic resources. We'll get more what's happening with the bank sector in Deutsche Bank in a few moments from the Frankfurt Stock Exchange. Patricia is there once again, but first, to run us through what's happening in London, here's Anna.
Thanks very much, Ross. Well, the FTSE 100 is just mildly in negative territory, down 6.7 points at this stage, 6,450. Of course, we're on Northern Rock watch as ever here in London, and the stock has really had a roller coaster ride yet again this morning. It opened up in negative territory, down around 13%, and now the stock is actually in positive territory, up 9%. So a big turnaround in the fortunes of this one over the last hour or so. But obviously, we have not seen any buyers queuing up to buy these assets, and that certainly is the big disappointment surrounding this stock at the moment. Elsewhere, we're also focusing on Wolseley. This is a plumbing supplier in the UK. It's very geared to the US housing market. They said in an update today that they didn't see any signs that the US housing market was picking up again. They actually said that some of the weakness in the housing market was starting to spill out into other markets in which they operate, maintenance and the like. So that certainly was poorly received by the market, and the stock is down 4.9%. BHP Billiton is another one to talk about. That stock is up more than 3%. That's on the back of a strong session in Australia. It then continued to have a strong session in the UK, in the London market this morning. BHP Billiton, of course, is going to update the markets later on this week about its trading, and there is some speculation that we could hear something fairly positive on the gold front. Patricia.
Well, the German market at the moment under pressure, down 0.3%. About 26 million shares have traded so far. And the main reason is, of course, to be found yet again in the financial sector. So amongst the main losers is Commerzbank, Deutsche Bank and Hypo Real Estate. Let me kick you off with the losers and Deutsche Bank. Of course, we do have today a Reuters report out whereby it is estimated that the actual losses due to the leveraged loan business of Deutsche Bank in a total value of 29 billion euros is actually 1.7 billion euros. And that was a bit of a shocker to the market. At the moment, Deutsche Bank actually trading down by about 2%, and about 2 million shares have traded already so far. I spoke to Deutsche Bank. Of course, they are very, very hesitant to talk about anything, so hesitant to talk about anything at the moment, but I get the feeling there is more bad news to come. What can they do with their leveraged loans, where they can either withdraw from the transaction or they can sell these loans off at a discount, which would hit the bottom line. And these are, of course, the issues they're considering right now for the next 3 quarters, as Mr. Ackermann said only last week. Commerzbank, the absolute loser at the moment, down about 2.5%. We do have yet again an estimate about how much subprime can impact Commerzbank. Saal Oppenheim came out with its latest estimates of about 450 million euros due to that exposure. Clean hit for Commerzbank, whereby Commerzbank itself about a couple of days ago was talking about 80 million euros. So you see there's a lot of potential for disappointment over the next few weeks to be found in the financial sector. Metro also down about 2% because of a broker's downgrade. Brian?
Thank you, Patricia. Now, all the major economic data is due later this week in the U.S. with the reports on home sales, durable goods, consumer confidence, and spending. All of those on tap for us later in the week. But today, it's pretty quiet on the Western Front, with just 2 Fed officials making public appearances. Dallas, Texas Fed President Richard Fisher speaks about the economic benefits of a higher education at an event in Dallas at 9 a.m. New York time. And at 12:30 p.m., new Chicago Fed President Charles Evans gives opening remarks at an agriculture conference in Chicago, and that is your global stock watch, which of course you can only find on Worldwide Exchange.
Well, Cathay Pacific and Air China are reportedly teaming up for a stake in China Eastern Airlines. The significance? Well, it could block Singapore Airlines' plans to grab its own stake in China Eastern. For more on that and the Asian markets, let's speak to Nico Harachi, Managing Director at N1 Asset Management. Thank you for coming on Worldwide Exchange, Nico. Let's start first with Cathay's potential move. We're waiting for any kind of official confirmation from Cathay. But how important would this deal be, given that Cathay wants to hang on to its the lucrative China market and its near monopoly at this point?
Well, thank you for having me. It's great to be back, and yeah, it's an interesting thing what Cathay is coming out with, and we're looking forward to see after the market closing what the statement is going to be from their side. But we think that Cathay they're continuing their strategical gain of market shares. I mean, we saw them a few years back buying Dragonair, and now coming out bidding for China Eastern Airlines. We think it's a good move for them in order to stay on top of the game, have the market exposure, and especially before the upcoming Olympics, where they're probably going to be ready to get a lot of revenues from going to China.
All right, let me ask you a sort of a broader question about the Asian markets. Today, although some of the big ones were closed, we did see the Hang Seng and the S&P ASX in Australia hitting new records today on some very strong buying. What's driving the momentum higher here?
Well, what is driving the markets in Asia? I've been asking myself this question a long time ago, but we think that the Fed 50 basis points move last week has been misinterpreted by the markets in Asia. Usually when the Fed comes out and cuts the rates, it's a green light for going into the equity markets. We actually think that the Fed came out trying to ease liquidity, especially in the US due to the subprimes, due to the credit markets. We're seeing now Hong Kong coming out lowering 25 basis points. But we don't think that Hong Kong actually is in need of lowering interest rates. We think they're doing this to the currency peg. So I was asked 2 weeks ago, are the retail investors understanding the risk of the markets currently? I don't think so. So I would suggest very tight stops.
Well, Nico, Brian Shackman here in the U.S., if part of the assumption is that the markets are being driven by this rate cut and the impact it's having, when will they, as you might say, wake up, or how long will this rate cut have an impact on the markets the way it has?
Well, this is very, very difficult to say. I mean, as we're seeing in Asia, we have so much liquidity, and the investors just keep pouring it into the markets. It is very hard to say when are the markets going to wake up. But I mean, we're seeing a market valuation in Asian stock markets which is close to the 97, 98 bubble. So we would advise clients to be very cautious, and we wouldn't advise them to actually buy at these stages. As I said, put in tight stops and actually maybe diversify the assets more. Try to look for market neutral hedge funds. That is what we really advise clients to do right now.
So, Nico, no interest in the resource sector. You know, BHP up again today with its announcement it's going to update on its reserves, and commodity prices doing so well.
Yeah, well, the commodity prices is doing very, very well. And we also think, I mean, going back to the Fed's move, I mean, we're lowering the interest rates, and we're going to see inflation going higher. And we're also seeing the commodity markets skyrocketing. We think these are also based on a lot of hedge funds trying to chase returns. But seeing this increase in the commodity prices, such as gold or oil, we do not think this is a good thing for the equity markets.
Okay, so very quickly, you like the financials and property, for example, but you're a bit concerned about some of the consumer stocks, is that right?
Yes, it is true. I mean, if there's a sector that we think that will benefit from this rate cut, it's for sure it's the property stocks. We think that in Hong Kong and in Asia, now that they're going to pay less for the money, we think that, and for the mortgages, we think it will benefit the property sector. We also think we like the financials. We like also the Chinese banks, as we have said before. We don't think that it's exposed to the subprime crises as we're seeing European banks, German banks, and the US banks. So we think fundamentally on a long term that the Asian banks, especially the Chinese banks, are very well prepared.
All right, Nico, always a pleasure. Thank you for joining us. Nico Harachi, Managing Director at N1 Asset Management there.